Welcome back to Market on Close. I'm Caroline Woods. Just a few minutes left in the trading day, about 9 minutes left. It's time for the big picture. Let's welcome in the team from Charles Schwab. Jeffrey Kleintop is Chief Global Investment Strategist at Charles Schwab, and Cooper Howard is Director and Fixed Income Strategist at Schwab Center for Financial Research. Cooper, let's start with you and the data that we did get this morning. Of course, it's all leading up to Friday's non-farm payrolls report, but we will get weekly jobless claims tomorrow, also leading up to it. But this was a read on the private sector jobs picture. What was the takeaway?
Yeah, so if we look at the ADP number, obviously the market doesn't pay too much attention to it. It does pay some attention, but it puts more weight into what's coming out on Friday. So I think that's really the important thing to watch, Caroline. Expectations are that we're going to add 150,000 jobs to the economy. That has been trending lower recently. So seeing that softness in the labor market, that's going to be something that I'm going to closely be watching, see if that signals potentially a shift in terms of the debate between 25 or 50 basis points for what the Fed does at their next meeting. So I think that that's going to be an important thing to watch on Friday.
Cooper, is there really a debate between 25 and 50, though, with Jay Powell saying he's cutting 25 at the next two meetings?
You know, I think the market thinks that there's a little bit of a debate. So there's about a 30% probability that they might go by 50 basis points. So I think that the market thinks that that window is still a little bit open. Also, keep in mind that we have about a month till the next meeting. So there is a lot of data that can flow in between now and then. So they definitely want to keep that optionality open. I don't think that the Fed is going to try to do some preset course. I do think that they want to keep kind of their options available to them. So I wouldn't be too surprised if we still continue to see that odds hover around 30% or so, assuming that the data continues to hold up okay.
Yeah, good point. Rate cut expectations change on a dime. We've certainly learned that over the past couple of years. Jeffrey, let's bring you into the conversation. Obviously, the Fed's main priority right now is the labor market, but the inflation picture is still very much is still there. And we have this port workers strike that began recently, yesterday at midnight, and continues to linger on here. It's still early days, but when will we get when would we start to see the real economic disruption from the labor dispute, especially as it could relate to inflation?
Well, there are some industries where it might be effective right away. A rule of thumb is that it takes about a week to clear the volume of cargo from a one-day port strike. That comes from shipping advisory firm Sea Intelligence and also from Maersk, one of the largest providers of ocean transportation. So backups can cause a chain of problems. For example, semiconductor materials like the ultra-pure quartz mined in North Carolina is essential for making silicon wafers, and it's the world's primary source. So shipping delays risk a slowdown in global chip production. Exports and imports of pharmaceuticals into the U.S. primarily go through those now idled ports. That's potentially life-threatening and could create big spikes in prices for shortages there. And of course, U.S. agricultural exports like eggs or pork from East Coast ports can't wait additional days or even weeks without risking going bad. So in some areas, particularly in foodstuffs, we could see inflation right away. It's noteworthy that today, one of the worst industry performing groups is food, beverage, and tobacco. These are areas that would be directly impacted by higher prices and shortages or even backups in terms of getting out these products for export. So even a relatively short strike, Caroline, 7 to 14 days, could have impacts in certain industries and countries and show up in the inflation numbers.
And also, I was taking a look at your notes, and you do talk about port efficiency being a big problem here in the U.S. And I think the question is, why is it such a problem? And is it automation that would actually fix the problem? Because we know that's one of the key kind of sticking points for the strikers.
Yeah, and so, it's easy to focus on the short-term issues of the strike and the inflation issues, just as we talked about. But a long issue, an important one, is what's at stake here in terms of the efficiency of U.S. ports. They are the worst in the world in terms of productivity, ranked out of 370 ports in the world by the World Bank. The U.S.'s largest port, Los Angeles and Long Beach, is dead last. And the U.S.'s second largest port, New York and New Jersey, is ranked well below average. And the third largest in Savannah, an East Coast port, was also very near the bottom at 367 out of 370. And the root cause is a difference in automation. The U.S. Government Accountability Office found that foreign ports have adopted way more automation technologies than U.S. container ports have. And that is a big sticking point in these labor negotiations. Yes, yes, it's over wages, but it's also over how much automation takes place. Automation seems to be necessary in order to keep up with the pace of global trade. And that's something where U.S. ports are now some of the worst in the world.
All right. Cooper, we already heard from Fed Chair Powell earlier this week before the strike actually went into effect, I believe. I know we heard from some other Fed speakers today. Has there been any talk about inflation potentially being a problem again in response to the strike?
Not directly in terms of the strike itself. I think the big thing about the strike is the longer it goes, obviously that creates more volatility and the potential for more of an economic hit. I think that what we did hear from some Fed officials today is that they don't think that the job is done in terms of inflation. But I do think that we do see that inflation overall is continuing to come down. But yes, the strike does pose a potential risk to inflation surging, moving up a little bit higher longer term.
Okay, and we have about a minute left. So, Jeffrey, I just want to ask you quickly about the China stimulus. Kevin Hinks was at the top of the show. Obviously, the Chinese markets are closed this week for the Golden Week, but we are seeing U.S.-listed shares of Chinese companies higher today. He said it's tradable, not investable, given some of the risk around China. Just in terms of how long we can see that, stimulus really giving a boost, what are your thoughts?
I think we've seen much of it already. If you take a look at the Chinese equity markets, they surged tremendously ahead of the closure. I think this is the third or fourth time we've seen a 20% plus rally in Chinese equities over the last 3 or 4 years. Ultimately, those stimulus, those promises failed to actually deliver. So we need to watch money supply growth to see if borrowing takes place. We need to see if local loan issuance picks up to see if the local real estate market is starting to heal. And we need to see confidence turn around so the consumer starts spending again. If those three things fall in place, this rally is for real. If not, it could fizzle.
All right, we'll keep an eye on those things. Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab, Cooper Howard, Director and Fixed Income Strategist at Schwab Center for Financial Research. Thank you both.